Who's got the first question? Oh, wow. Let's start with Kieran. I saw your hand go up first. No.
Hi everyone, I'm Kieran. Rob, this is for you. I'm a property sourcer, so I find some really good deals for my investors. I'm looking to also do my own developments, but I've never done any myself. So how would you help me for the first time to be able to do that? Although obviously I've got the experience of sourcing good deals, so I know the numbers stack up, so I do the due diligence. But how would I get the funding myself as a first-time developer?
Good question. Generally, we are looking to work with experienced developers, but obviously you've got a background in property. So someone who's just coming to the platform trying to wing it for the first time, we'd probably tell you to go away and try and do a little bit by yourself first. But once you know what you're talking about, we literally it's at the minute as Thomas said, it's a hand-holding service. So we'll be on the phone and explaining that 25. We don't look at deals at the minute that have got less than a 25% return on cost and a 20% return on GDV, and we're working at building the whole onboarding process into the platform. And that's basically, it is the hand-holding surface, but it's online. It tells you exactly what you need to do, step by step, exactly what document you need to upload, and if it doesn't meet the criteria, then it's going to flag up and it's going to tell you what you need to do. So basically, everything's there.
Okay, I'm happy with that. But in regards to what would be required as a personal guarantee?
If you a £1 million deal, you've got 70% bank finance. You need the 300 grand. If you wanted to borrow the full 300 grand, we'd want twice as much. We'd want 600 grand in assets that we could have as a PG.
Okay, thank you.
Your house and your dog, basically. Anyone from this side of the room? Who else has a question? Lady at the back, let's go.
Hi, my name's Karen. I guess the question is to all of the panel. We've heard lots about the positives about crowdfunding. Where's the catch?
Yeah, it's a good question, Karen. So we actually met, well, I think I met Thomas first and then we met Rob. We actually, Thomas and I both saw Ranjan speak at your first event, and then we met Rob at an NLP event. So that was actually in the middle of the last crash, Karen. So at that point, people were losing money, developers. So we've got some good friends who, lost their house, lost their shirt, lost everything for some people. So we're very mindful of that. So there's no promises. We don't make any promises. Investing carries risk, and we have that rubber stamped over everything. But what we try to do is, educate investors to understand where the risks are and how to mitigate the risks. So, the catch is being able to assess where the risk is. So typically, the main risks really when a developer is looking to exit is the market conditions at that point. So developers will have projections, so they'll project valuations, that the properties will get sold at. So we obviously do sensitivity checks. We use technology to do that. So our program has built from scratch some coding. It's like a spider that crawls across certain websites that give land registry data for sold prices. So we will sense check the developers' projections for the GDV, which is a gross development value, against what we think the properties will actually sell for now in the current market. So the catch there is we're in the middle of uncertain times right now. We're in the middle of Brexit. No one knows where, how that's going to affect the economy. One thing that we do know right now is it's very uncertain. So the liquidity of the market has slowed down, which means that properties aren't selling as fast as they would. So to mitigate that risk, as Rob said, we're looking for a higher return on cost. So where it would normally be 20% return on cost, that would be an industry accepted return, a margin, where we're looking for 25%. So with the data that we're displaying, it's up to you to check that, and the internet makes things a lot more transparent these days. You can look up net house prices, Zoopla, the mouse price. You can actually download the title registers of properties at Land Registry, and you can check what we're displaying to see if it matches up. So to find out where the catches are, there's some of the ways of figuring out whether the data matches up.
Can I throw something in as well?
Okay.
We spoke about land grabbing. I'm doing mic grabbing here. Sorry. My name is Fredrik Salval. I would like to add to that. One reason why I actually invested in the platform behind it, in the actual business, is unlike so many of them, people who understand property, setting up a platform, versus people who understand tech, who have no idea about the ups and downs of the sector. I personally see some of the platform providers actually disappearing when it comes to the next tough times. So I had to throw it in. Fredrik Salval, I'm one of the guys behind.
So that's Frederick, who's one of our investors in the platform. I was actually going to say that as I mentioned earlier on about working with experienced developers, one of the benefits of working with experienced developers is that, as Thomas alluded to earlier on, is that they don't just have one exit. There's several exits. So again, it's all about mitigating risks.
Let's have this gentleman here.
Hi, my name is Will. I actually work in crowdfunding, and of course, someone asked, what is the catch to crowdfunding? The biggest catch, of course, is you guys, let's be honest, have no idea whether there is enough liquidity, enough cash in the crowd to fund a deal. That is a problem that will go away with time as it becomes a bigger industry. That much we know. The problem is this: if you have a deal on the table and you need to get it over the line in X number of days, you have no idea, am I right in saying, whether or not that cash will be there on time to complete the deal, unless you've got your own stash ready to put in place. That's the first half. The other half was, sorry, you said no multiple questions, but do you fund things like buy-to-lets, or is it purely developments?
First, what was the first question again? I forgot now already.
The first question is,
Do you have enough cash to get
Yeah,
across the line?
yeah.
So working with experienced developers, a lot of them have got existing databases of investors. That's one of the benefits, because you're quite correct that if you just, and I think it's a big misconception with crowdfunding, that if you just plop a deal on the platform, that it's going to fund itself. There's a lot of work that happens behind the scenes, and working with experienced developers that have got existing databases, then they're able to. Whereas since the FCA have brought the regulations in, they're not able to funnel those or to work with those investors. They're able to bring them through the platform. So what we bring some of the cash, and the developers will use their existing database and bring that through the platform as well.
I mean, the other thing that's worth mentioning is it all depends on how the deal is structured. So, for example, I mean, some of Thomas's examples where the deal was already there and they used crowdfunding for specific purposes. But the other way people are structuring it is to exchange contracts with a delayed completion. And then you've got much more time to get that sort of funding in place. So there are all sorts of different ways of skinning that particular cat, I think.
I guess we'd look at them, but generally, yeah, depends on the deal.
To that. Yeah, well, as I mentioned in my talk earlier, so one of the things we're encouraging developers to do and investors to look at, and it's similar to Ravi, the guy that's speaking at next month's Baker Street Property Meet, is encouraging build to rent. Yep, so the idea of quick bark, that, and you know, there's surprising how the herd mentality is just encouraging people to go into deals just because everyone's going in, because there's a few shiny pennies being promoted or lots of shiny pounds, and it's not quite like that in the real world. So in terms of buy-to-let, what we think one of the growth areas will be build-to-rent, and that's what Ravi's talking about on the next talk. So we're actually in the middle of a capital raise ourselves, so we're because we've decided to pivot our model and fund other developers, the cash flow into the business is less per deal because we're just charging a commission. And obviously, you know, the cash input the business is going to take a long time. So the key places we see the finance coming from and people we're talking to is there's actually a lot of institutional money out there right now. And these guys, you know, pension funds, Thomas is selling some of his deals to pension funds, that they are interested in the rental portfolios. So if you can do a build to rent, you know, some of Thomas's sites, there's one in Sheffield that's like 700 units or something, Thomas, yeah? I mean, Thomas can probably expand on that, but the pension funds have so much money and they don't have secure investments to put it in, so that they're interested in the rental income and then the capital growth in the future.
That's going to be the next wave, because very few crowd funds do buy-to-let, because most private investors who put up the money don't want to be in for 25 years. Typically, they want to be in for 12 months, 18 months. But what's coming in now as crowdfunding is growing, the institutional investors are taking an interest, and they are happy to come in at 25 years. And that's going to change things quite that's going to be another stepwise change, really, in the whole crowdfunding space, isn't it?
Yeah. I'll just add something, then Rob's got a particular deal to talk about. So we are a crowdfunding company. Who's heard of Funding Circle or Lend Invest? Just by show of hands. Interesting. So both of those companies are crowdfunding companies, but the thing that most people don't know is that it is probably 90% of the funds that go into those businesses is institutional money. So it's crowd, but it's just very big crowd investors. Yeah, and that's the same with our business. So in our business model, so we're doing this capital raise at the moment, we're predicting and projecting that 80% of the investors coming in will be sophisticated investors or high net worths, and then 20% in the first 2 years will be smaller investors. Yeah, and then over time, as technology and, you know, just awareness expands it, then smaller investors will come in. But it's mainly the institutional and larger investors that are funding companies like this.
And very quickly to go back to buy-to-let, I was thinking smaller scale, but we've just, I can't go into specifics, but there's a deal on our platform that went live a couple of days ago. And that's a large project, £3 million almost, and it's a rental deal, so it's reasonably high yielding, and that's a 5 to 7 year investment. So and it's being rented out for the duration. So I hope that answers your question.
Any more? Let's get Richard to go all the way over to this side of the room, and this lady here in the purple. Let's have this lady in the purple. I saw her hand go up first.
Hi, I'm Leslie. Great to hear you talk about crowd with us. What does it cost? What does it cost for a developer to come on board with you, and what does it cost to the investor?
So Leslie, yeah? Yeah, so we charge a fundraise fee, Leslie. So it's 5% of the funds raised for investment that we bring to the deal. If you have your own investors, so a lot of the developers, Rob's got, I think, 60 developers who want to use the platform this year. Most of those developers do actually have investors that they work with. So for investors or money that they bring into the deal, there's no cost, so long as our out-of-pocket expenses are covered. So we have a lawyer that acts for crowd with us, which is checking the deal for the investors, and that ranges between 2 to 2.5, 3 grand. It depends on the size of the deal and, you know, the public and the professional indemnity cover. Yeah, so that's a fixed cost, and then it's 5%, and then we have a management monitoring fee, which is 15% of the deal profits if we've raised the money with investors. So that will come from both sides. So if you're doing a 50-50 deal, and it's an equity deal, where the developer gets 50% and the investors get 50%, we'd get effectively 7.5% in between. Yeah. So I hope that answers your question.
There's no cost to invest, is it? So what does it cost to investors?
Oh yes, there's no cost to investors, obviously. Yeah.
Anyone else? Oh, lady at the back. Yes.
Hi, Rie. You mentioned about sophisticated investor and high net worth investors are majority, and then 20% is a small investor. Internet age, anyone can access being crowdfunding. So number one, what is your criteria to find out the investor truth? But some people brag themselves how successful investor they are. So what is your criteria? And at the same time, vice versa, how you show investors that you are most credible crowdfunding organizer.
So when you use the term investor, are you talking about the person that's investing in money in deals, or the developers who are placing their projects?
They need to choose. They need to decide who they're going to work with them, investors.
Okay. The due diligence on investors, I guess.
That's right. Detailed criteria.
Was part of your question about the developers? So the developers promoting the deals and, you know, how good they are, and what's the due diligence?
So you don't deal with directly with investors?
Sorry? No, it's not the investors. Okay, so yeah, it's the AML and the KYC. So we do anti-money laundering checks, is we use an electronic identity verification company for that. So we run a check against, for the UK, it's usually the UK credit header, which is a database which basically matches up.
So you use a third party?
Yes, we do. Yeah.
Apart from the credit score?
So yeah, it's similar to Experian, but it actually reconciles against public databases. So, you know, an investor will have to upload a passport or a driver's license to our website. You have to put your address in. So if someone is a fraudster, we will, and we've had this, we've had to, a couple of transactions that were declined because people's addresses weren't reconciling on the database with what they'd put.
If you don't mind, how much percentage to be declined, those fraudster?
We've only had 2.
Only 2?
Yeah.
Great.
Yes. So, yeah, it's actually, this is a hot subject for the FCA. So anti-money laundering and, you know, stopping terrorism is top priority. You know, there's a lot of focus on that. Yeah.
Okay.
Someone asked Thomas a question.
Anyone? Let's have this gentleman here.
My name is Salim, and I'm involved in property investments, residential, predominantly in London. And I just wondered, on the crowdfunding question, you mentioned earlier that the level of return to those that invest is anywhere between 6 and 18%. Was that correct?
That would be for typically for debt funding. I mean, there's no real sort of average because it depends on the developer and it depends on the deal, you know, and the developer, you know, how quickly they can get cash in and how quickly they need it. So we've actually been working on projects for the last 8 to 9 years, and our typical cash-on-cash return has been between 60 and 100% per annum. Yeah, but when they're generally on smaller projects, so when we're talking about scaling up and developers are doing, you know, 10-unit schemes, 100-unit or a few hundred units, it's not as easy to get those returns consistently, especially in the market that we're in now. But if you look at the layers of finance, so generally there's a first charge, and if any of you are developing deals, you know what those costs are. It's generally like for buy-to-let finance, it's about 3 or 4% plus entry fees. For development finance, for an experienced developer like Thomas or Ranjan, you might get development finance from Lloyd's for 4 to 6% per annum. Yeah. And then the investors who put the mezzanine finance, which is the chunks on top of the first charge, you would obviously expect higher returns for that. So mezzanine debt finance will typically, you know, for a low-risk deal, we've, you know, paid 8% because it's quite low risk because of the structure of the deal. Sometimes it could be 12, it could be 18%. Yeah. So if it's equity where the investors are buying shares in the deal, you know, they're in there for the ride. So if things go pear-shaped or off-piste, then, you know, potentially there could be, it's risky. You know, hopefully there's not going to be a loss, but people could be exposed to a loss. So on those types of deals, you would expect a higher return. Yeah, which, you know, should be 20%. Sometimes it could be 30%. It could be 40%. But in the market that we're in now, it's taken a lot longer to sell properties. So if a project was anticipated to take 12 months and it takes 2 years, well, that halves your percentage return per annum.
Sure.
Yeah.
Thank you.
Yeah, so we would, as developers, some deals are very good, some are not so good. So we would then, you know, tell them what we're happy to pay. So sometimes it could be 20% a year or more sometimes. So again, it depends on the developer and what sort of risk profile they have.
Assuming that I'm talking in the context of someone who would be investing in a crowdfunded project, just out of interest, what's the rate of projects that have failed over the last few years that you've been involved with, that have failed to return the kind of
Projects that
Never not paid your investors back.
projects that failed, how many? Oh, yeah.
We don't do failed projects. That's a foreign word to me. No,
But
we
that's
don't.
something maybe you guys want to pick up. So if it all goes Pete Tong, what happens? And because there's a certain pecking order, as you allude to. Not all lenders are equal. Some are more equal than others, and some are going to get their money first, and some are at the back of the queue and basically take the first tranche of loss.
Yeah.
And if you're going to do that, you want more return for it. But what happens if the project goes Pete Tong? What do you do to make sure that the money is returned and people in the right pecking order get their money back?
Yeah, so it's a good question, Ranjan, and this is really the crux of the whole business. You know, it's where is the risk and how much is that risk? So between Rob and I, and Thomas, we've actually done quite a few of these deals with Thomas in the past. We've done over 50 deals so far, and touch wood, we've never lost money on a deal. When I was first starting, I had one small deal, which was a joint venture. I didn't use a lawyer. It was like my 5th deal. I thought I was pretty shit hot at the contract. Excuse the French. And I had a lady who pulled out of a deal. It was actually she owned a flat. And she decided she was not going to honour the profit side of things. And I made a fatal mistake. I gave her my bank details to send the capital back, which was only like 10 or 20 grand, I think. It was a very small project. And that's the only one that I personally lost profit on, but I got the capital back. Yep. In terms of deals that go pear-shaped, going back to Ranjan's question, it comes down to the structure at the start. So most of the time, the deals that we've worked on ourselves, there's been quite a low loan-to-value on the first charge. So we've deliberately done that and raised more equity at the start of the deal so that if the market is deflated when we're looking to sell, we can switch to buy-to-let finance and refinance. So that's how we've been managing it, and we're encouraging investors and developers to think like that as well. So the returns will potentially be less because, you know, instead of sticking in 30% equity, they'll be sticking in 40%. So obviously if there's more cash going in for the same return, the cash return is slightly lower. So if all of that fails and things go pear-shaped, we, as Rob talked about before, we do look for personal guarantees from developers, and this is for debt deals, yeah, not equity. Yeah, so not equity deals where investors are buying shares. If they're buying shares, they're in it for the full ride, whether it goes down or whether it goes up. You know, they're basically, you know, win or lose in that respect. But if it's debt, we have personal guarantees with developers. Yeah, so we have another company which is a trustee company, and it's Crowd With Us trustee, so that's there to act on behalf of the investors. So we'd have to appoint administrators, to look to recover the asset and go through that process.
I'm just going to throw in a couple of comments on this, because we're looking at putting some of our development projects in the next 6 months on crowdfunding platforms. And as part of that learning process, if you like, it's always a good idea to invest yourself in a variety of crowdfunding platforms. So we've done that over the last 6 months. Now, there are a bunch of, I can't remember the links to this, but go on Google and just type in crowdfunding review. And there are a bunch of sites that have come up now which review and keep stats on various crowdfunding platforms. Now, the interesting thing that I've noticed is that the bad debt or the failures in property crowdfunding is much, much lower than general crowdfunding. You know, all the funding circles and the loans to individuals and small businesses and all of that. Their default rate is far higher than property. And the reason for that is because it's very difficult for any property to go down to zero. It all depends on the money you're putting in and where you are in the pecking order. And it's worth researching some of those sites and to see, and that's why I haven't actually invested in any non-property crowdfunding site, because the default rate is far lower in the property space for that reason. I don't know whether you guys want to add anything to that or remember any of the sites that I'm talking about. There are various review sites, but I can't remember which ones I've used. There are 2 or 3.
Yeah. Thomas,
Go on.
Yes, so if you look at it from an investor's viewpoint on the crowdfunding platform, if you look at what the bank has got the same security as you have if they were a first charge lender. They also have the debenture, they have a charge, and they have a PG. So as an investor on crowdfunding, you virtually have the same security as a bank does. So it's pretty strong security that you have, a debenture, charge, and a PG. So keeping in mind that a PG means if anything goes wrong, you can go after that developer's other assets, and those assets have been checked to have value in it. So there's quite a lot of security in that.
Oh, I think we're just run out of time. Any closing comments from you guys?
Yeah, so we're over here if you have any further questions. If you're interested in funding deals, by all means give us a shout. If you're interested in investing and you want to understand more about this, we are probably one of the more anal crowdfunding properties, analytical, yeah.
Come up with a better word.
Well, we are.
You don't want to be talking out the arse.
So analytical, because the devil is in the detail, and the adage is if you can mitigate the downside, the upside looks after itself. And that's the formality we want to carry our business out
I like the
with.
comment that Rob said about, because a lot of developers, you mentioned 25% on cost, your criteria, when a lot of people have been looking at. So you've already kind of forward thought some of the uncertainty and amended your criteria now, which is prudence, really. It's good.
Yeah, so just before Christmas, we had a large equity investor come on board, and he owns a bridging bank. So we spent quite a bit of time working with them, going through a full underwriting and due diligence process, which is the process that we work with the developers on.
For me, I'm not a detailed person. I'm a bigger picture person. I don't enjoy all the paperwork and all the detailed stuff, the technicalities and the legal issues. So for us, having someone else take that over for us is really a big bonus going forward.
Brilliant. Okay, listen, thank you guys. It's been very informative. Learned a huge amount on